Malik.
Good morning, everyone, and thanks for joining. My name is Malik Reddy, and I'm the Regional Vice President of New York for the New York team for Telangana American Telugu Association and Board of Director for New York Telangana Telugu Association. ఈరోజు మనం అందరం ఇక్కడ గ్యాదర్ అవ్వడానికి రీజన్ is that the New York team of Telangana American Telugu Association, which is the TTA, under the able guidance of Dr. Paila Mallareddy garu, who is the founder of Telangana American Telugu Association, a national organization, and a strong supporter and the biggest donor for many other national and local organizations, is exclusively bringing a virtual tax planning session for all the Telugu community and everyone, in fact, for the benefit during this tax season. Telangana American Telugu Association, TTA, being a national level organization for Telugu community, is organizing this event in association with New York Telangana Telugu Association, NYTTA, which is the local Telangana organization in the tri-state. This is the tax season, like every year, and we all know manam andaram enta busy untam planning different ways of filing the taxes and many more. For some people, this might be as simple as filing a tax by themselves in TurboTax, and for some of us, it is as complicated affair, with multiple itemized options. But one thing that we all agree is that though we all file these taxes every year చేసేది కదా, కొత్తగా ఏముంటది అనిపిస్తుంది, but there is so much that we do not know. Once we go through this entire session, we will know how much that we are not aware of. It could be because of us, most of us are not from the financial background, or just lack of knowledge, or many other reasons, right? But every person deals these tax statings in different ways, so hence it's difficult for us. That's why we all reach out to a CPA. So today we, the Telangana American Telugu Association, TTA, along with New York Telangana Telugu Association, NYTTA, has reached out to an experienced CPA from our own Telugu community, whom most of us know. He's extremely knowledgeable and generous enough to share his knowledge with all of us, not only from a tax planning perspective, but also for future planning and how to save money and do the things the right way. Tax planning is a vast topic, so you can go as deep in each case, but due to the time constraint, he will be covering most topics in his presentation. I request us all to stay muted during this presentation, and at the end, we can open the floor for questions and answers. If you have a question during the presentation, please post it in the chat or in the WhatsApp group or in the Facebook, so you don't forget, and we will cover all those questions from the chat or wherever possible during the QA session at the end. With this, I'd like Vani Singarkunda, who is the TTA's cultural co-chair and NYTTA's executive committee member, to introduce the respected CPA. Thank you all once again, and Vani, please go ahead.
Okay, thank you, Malik. Very good morning to one and all on behalf of TTA and NYTTA. So let me take this opportunity to introduce the man of the event, Mr. Chandrasekhar Narige garu. He's a CPA by profession, and he's been helping his clients from the past 15 years. He has an office in Valley Stream. His specialized services include all types of corporations, business income tax preparations, individual income tax preparations. Besides, many other services include like the retirement plannings and investment strategies. That is a little introduction about Mr. Chandrasekhar garu. And like Malik mentioned, while Chandrasekhar garu is walking over all the details, please stay muted. And if you have any questions, please post them in the chat box, Facebook, WhatsApp. Wherever possible, we'll cover all the questions at the end. And at the end, Mr. Chandrasekhar garu will address all the questions. So I welcome Chandrasekhar garu now. And sir, it's all yours, sir. Take it away.
Thank you very much, Andy. Andarki namaskaram. నాకు అందరికీ అవకాశం ఇచ్చిన నైటా టాటా ఎగ్జిక్యూటివ్ కమిటీ బోర్డ్ మెంబర్స్ అందరికీ థ్యాంక్ యూ వెరీ మచ్, అండ్ ఆల్సో ఆల్ ద మెంబర్స్ ఆఫ్ ద నైటా అండ్ టాటా మెంబర్స్, థ్యాంక్స్ వెరీ మచ్ అండ్ అటెండింగ్ దిస్ ఈవెంట్. So I can start presenting my screen, or so let me present my screen. So I would like, I would like to discuss today mainly about the income tax, individual income tax, and some business taxes, and also what's new in 2020, and also a couple of items which I wanted to go over that like no one is aware of. Like most of them they are aware of, but some of them there might be missing items. I'm going to explain a couple of them about that. So I would like to start with the basics on income tax returns first. Um, and this is just a disclaimer. This is not just the information content on this webinar, and related materials are not intended to constitute advice of any kind of a rendering of consulting or other professional services. But you can talk to me like individually if you have any questions. Always welcome. And some basics about like income tax returns. If most of us there are like two types of like basically for individual there are like resident tax returns and non-resident tax returns. Like most of the non-resident tax returns, like for students, they came for studies here. A couple of like they are not here more than six. Like some of the non-resident categories. Most of us we fall on the resident categories like H1s and whether they are more than 8 months here and 180 days more present, based on the some like all the citizens, green card holders, and kind of like those eligible for the resident 1040 regular tax returns for individuals. So most of the basics like on the income tax returns, everybody they have to be aware of that. We have to report like a global income, like even if you have like more than $10, we have to report on the tax returns here. So no matter where it came from, like the like global income kind of. So some of them, like most of the things that we do cover is like W-2s, mainly that we work for on the W-2 employment basis, which is those we have to, most of the common things for everybody they receive from salaries and wages that usually we report, they report on the W-2s. So in here, and also the income reportings, like basically the tax interest income, especially more than $10, we have to report on the returns. And then also the dividends and the capital gains and like Schedule C business income, like self-employment income, and a lot of other like real estate rental incomes, pretty much all of them that we have to report on the basic. This one, some of them they do work on multiple jobs, and they so do some part-time jobs. Some they do like on some of them they do like some freelancing work on 1099. They get 1099s. Like how to report them and in the tax returns, and also some like most of them some of them they do like the work in New York and live in New Jersey, or live in work in New Jersey and then live in New York. They might have some difficulty for them to file their own taxes, how to apply the credits between the states. Some of them they might have to go to some other states, and then they live in New York State, kind of like some people Connecticut, like that. So all these kind of like some is like complications they might face into. So they can able to how to apply the credits and all. They can able to do some individual credits. Say for example, one of the person if he is working in New York, like New Jersey, living in New York, and so they actually employer are supposed to withhold the taxes for both states, which are providing like the state, but they have to pay for the wherever the earnings from. Like if they are earnings from New Jersey, they have to pay state taxes to the New Jersey, and then because they are living in New York also, they have to pay New York taxes as a living taxes. But they can apply some credits which already they paid to the New Jersey. So they can apply for the credits which paid to the New Jersey, and then remaining they can have to pay to the New York. state. Like that, if there's they live in New York City, but still they have to pay entire city because they live in the city for the entire wages for all the income or earnings from there. That's mostly for the New York, New Jersey for individuals. They have to file for the state taxes. So the couple of things that I would like to go over, the next one, like everybody is more interested about the tax tables. How does it look mainly? So how much I owe, like if I make 100,000, and what will be my scenario about the tax rates? Some of them, they think that, okay, if I'm, okay, 100,000 I'm making, okay, I'm in the 22% tax rate as a married filing joint. If you look at that for single individuals and the married filing joints, and it starts for 22% starts from 80,251. And so that's, they think that, okay, well, I'm 22%, okay, I might have to pay entire 22% for the 100,000, like 22,000 only federal taxes I'm paying. They might usually think that way, but that's wrong. It's actually what happens is that, say, for example, if you are married filing joint return, and both your husband and wife together, they are making, of course, they are making 200, 250, 400, I don't know, but just giving scenario for 100,000, say, for example, if they make 100,000, and then the for the 100,000 is not 22% at all, completely for this one. So there is a standard deduction for 2020 for 20,800 for the couple married filing jointly. So it has to be minus from 100,000, and then remaining will be 76,000. Sorry, 74,800 on that, and you will be paying only up to, for the first 19,500, you will be paying only 10% tax rate, and then you will pay like the remaining from 19,500 to, then you pay up to 80,000, you'll be paying only 12%. So then you'll be for the after above 80 to whatever the 100,000, which difference you'll be paying for that, because anyway you are not up to 80,000 too, but you're after the standard deduction, your income was only like 74,600. So then we say, for example, 75,000. You are still not on the 22%, but you're just only 12% for that. Some you paid 10% and some of them 12%. So on average, like if I just give like this is the next thing. This is for the single, that's 24% starts, the 100,000, this is just a worksheet for the 100%, 100,000 above for the tax table worksheet. So it starts up to, if they have like for single person, if they made 100,000 and above, then up to 100,000, this is the tax rate, 5,920. For the federal, he is paying 5,920 here. So that means the federal tax was plus you have to 24% of that one, 24,000 minus this, subtract this 5,920, which is about close to 14,000 he is paying. So approximately 14,000 means his tax rate on 100,000, but he has to deduct the standard deduction, which is like 12,000. So that means he will be paying like on 112,000, he's just paying like 14,000 some change for the taxes. So that means the net tax rate for him is just close to 13 to 14% as a single, even though if we make 100,000. When it goes to the married filing jointly, that 100,000, wife and husband together, if they make together 100,000, then they have to subtract 8,420 from 22%. So 22,000 minus 8,400, that is about close to so 14,000 something. So that is so they close to 12,000. About like close to 10,000 because they have to subtract 24,800 on that one. Just like on approximately the tax rate might come up to like 8 to 9% for them for the net for up to 100. if they make like 200. So that's about the not like everything they pay like 22% straight away. If there's somebody on the 200,000 married filing jointly, that means they are in 24% tax rate. That doesn't mean they pay all 48,000 for the 24% of the 200,000. They end up paying like less on the this amount less. Then you can calculate the net tax rate. That might be 24 minus 48 minus 11, 12, 32. They might be like 16% on average for the federal. So that's about a bit about the tax table, and most of them, they are aware of that. Like the couple of the tax credits, some of them they know what is a refundable and non-refundable taxable tax credits. The child tax credit, which the some like they are giving as a social security. If the dependent has social security, then they give like and they have to be qualified children. They get like 16 below. They get like $2,000 credit for the 2020. So that's 2,000, and also there is a some if the income is not enough for the taxable, there is a chances of the refundable too. They can reduce the tax, and then if it's refundable too. So that means if they paid up to tax of $1,000, then if another 1,000 can be refundable tax, refundable too. So that means they can reduce the tax. Refundable means it's like we can get like a refund of the tax. And they can, and next one is earned income tax credit. This is for the little bit low income individual. So that's about single maybe like about 14,000. Married filing joint is about 28,000. Sorry. The credits are there that mostly the income is like 40 to 48 with the kids, 2 or 3 or more kids, they can get like 1, 2, 3 kids, they can get the income tax credit. And most of our community, they might be interested in the education credits, like what is like what type of credits they have. Their children go to the like colleges, and they are paying a lot of tuitions for their children, and then they make certain income and above, they might not be qualified for that. So these are the couple of income limits when they are, this is just for the married filing jointly, the income limits that is mentioned here, which is like, there is a 3 kind of eligible things that they can take for the qualifying expenses of the education. Which is the tuition and fees deduction, that is like $2,000 for 4,000 for the married couple. And so they can, the limit of the income for both of them is 160,000. And for American Opportunity Credit, this is only eligible for the first 4 years of the undergraduate for that. And their income, the family, the main couple married filing joint income has to be less than 180. And then, so that is most valuable. They can get up to the credit of like $2,500, the max American Opportunity Credit on if they pay like on like that's like up to 50% of that amount. Like if they pay like $5,000 tuition, they can get up to 50% of that, like $2,500 credit on the tuition. That is eligible for the first 4 years of the undergraduate students. And another one is like lifetime learning credit, but for like graduate students, it won't get the American Opportunity Credit is not eligible for them. And for lifetime learning credit, this is for 10,000. If they paid up to 10,000 tuition payments, they can deduct up to 20% of that on that. But this is like, 20% of the 100,000, say if they pay 10,000 for the tuition for the year, they might be eligible up to 20% of that 10,000, which will be $4,000 to $2,000. And also that is Okay, then for the lifetime learning credit, that is, you can, n number of years, there is no limit, like American Opportunity Credit, like only 4 years, each student they can eligible for. But for this lifetime learning credit is like no ending for them, but only the AGI, 138 for the married filing jointly. This is like almost half for the individual singles and half of the limits. American Opportunity Credit, one of the important thing is that it's refundable to up to $1,000. Even say, for example, if your income is to your 200,000, 500,000, or something, that your dependent is going to school, but he is not. He is actually, you are unable, even though you claim him, but you won't get any benefit out of claiming just only the exemption more than 16, then you get only $500 by claiming the dependent, even though you pay like 30,000, 40,000 tuition fees. But sometimes what happens if one of the say if both of you are there, if you are making like 200,000, then you are not eligible for it, and your son like or daughter, they pay like 20,000 for the tuition for that year, but you get claiming the dependent, you get just only $500 as a dependent. Now they file themselves and they get like $1,000 as a refundable credit. That means they pay tuition for like even 5,000. If they pay like 2,500, still they are eligible for $1,000 of the refundable credit. So they get dollar to dollar $1,000. I mean, like for that amount. So that is kind of that's one of the American Opportunity Credit that's only eligible for the first 4 years of the undergraduate college. So then retirement saving plans, everyone is mostly aware of what is the traditional IRA and then Roth IRA, 401k, and how do we do the Roth conversion from traditional or from the these IRAs and all. So that's usually there are like a couple of limits, just the limits for the contribution for the IRAs. For this one, they might, if most of them they have the 401k through employer plan, then they might not be eligible for the traditional IRA or the Roth IRA, but they might be eligible to contribute to the Roth IRA and then backdoor conversion, like convert to the Roth IRA in that one. So the traditional IRAs are mainly these are like the tax deductible contributions. And so it's pretty much tax deferred. That means when you get like when you get withdrawals or distributions from the traditional IRAs at the retirement, you still have to pay taxes on the income and also earnings. After if you withdraw before 59 and a half at the age, you have to pay 10% penalty for the traditional IRAs or this one. So for the Roth IRAs, there is no tax deductible on this one, but whatever the earnings on the Roth IRA can be deferred, like it's free, so you don't have to pay tax on that one. So that is again. So there is an age limit for the withdrawal for that is 59 and a half for that. The same 401k is through employer contributions. That is again the tax. If you are working with the same employer, you can take a loan, but some of them they might consider to take a loan, but most of them they might not give for the loan permissions on the 401ks. But that is again 59 and a half at the age. Then only you can able to withdraw that 401ks without penalties. But if you withdraw before that, if you change your employer, you can able to roll over from one previous employer to the new employer for the 401ks to keep it in one place. But if you withdraw that before 59 and a half, you pay 10% penalties on that. In the Roth conversion, as I mentioned before, like backdoor Roth IRAs, the traditional IRA can, even though you're not eligible, you can contribute to that. But again, you have to convert to the Roth immediately. So to avoid the penalties. Otherwise, if you don't know, you contribute in the traditional IRA, even though you are not eligible to, even though you're not deducted on the taxes, but you keep the money in the traditional IRA, you just contributed it. But every year there is 6% penalty on that amount without that you have to pay almost 6% because you are, even though you're not qualified, if you contributed to the traditional IRA, then you'll be paying like 6% taxes on that and 6% of penalty, sorry, on that one. Say, for example, yeah, just before I go to the all these savings for dependent flexible accounts, I would like to give some information about like how the reporting and all. Let me show, I'm going to share another screen.
We can see Shekhar.
So, yeah, can you please give me the, I'm able to share the screen, right?
Yeah, can go ahead.
We can see your 1040.
Or 1040, right? You can able to see.
Now we are seeing your PPT.
Oh, okay. Got it. So, okay, so here this is just a sample 1040, which usually like most of our individuals, like resident individuals, they do file it. Like major, there might be like the couple of the these are the standards like the income reportings and the dependents and all. Say if you make like $150,000. And if you make $150,000 and then like, this is simple W-2 wages. And how does it work? They have to report like a tax interest, taxable interest, ordinary dividends, and IRA distributions, anything like pension and annuities like that. Social Security benefits when they become like 62 or 65 older, they get Social Security. That's 85% of the Social Security wages are taxable. We think that Social Security is not taxable. If it is like, if they make more than 25,000 income, 85% of the Social Security Social Security benefits are taxable. There is some calculation, but that is taxable though. If you make, even though if you just get only the Social Security, then it's not taxable. But if you have like other pensions and other income, then it will be some of the Social Security benefits are taxable. So a couple of them like the capital gains, everybody is, most of them, they do the stocks and all, they have to report on the Schedule D. And this is other one, so like that. So for from 150, they just, if they pay like some 22,500, so that's about 150 means, like, the one, which will be 15% of the 150 is like 22,500. So that's, even though there are like, just not to worry about this, all these numbers, I will come to that later. So this is the standard deductions. They can withdraw after the standard deduction and some other, I will come to this one, the 2,600 and 3,600 later. So then their income like will be like 126 after the 150, then standard 126, they will be paying like $19,000 as a federal tax wages. So then still even the 15% they pay, they might get about like close to 2,700, something like that. This is approximate numbers, not exact numbers. That's how it will be. And also I mentioned about this on the American Opportunity Credit. If you are looking at this here, so that is about that, the refundable. These where you see like 27, 28, 29, 30, 31. These are all 27 to 30. These are all the refundable credits. These other credits, what we see, those which is child care and dependent tax credit, dependent care credits, and some other credits which are, we can reduce the tax, but it won't be refundable. So you can reduce the tax up to 0, but it won't be refundable. So for example, like some of the credits, you see that, okay, I'll come back to that later. So this is just an example how the 1040 looks, and how what will be the refundable credits, and how do you, what are the exceptions. Child and dependent care credit, one of them that I forgot to mention, that is about like if you have like 2 kids, or the max like the $600, the max you can take the credit, which is a $3,000 deductible, 3,000 times 20%. That also again there is a reduces, not entire 600, the max $600 for each child, and for if you have 2 children, then it's $1,200 child care credit, and then child tax credit is $2,000. Child tax credit is $2,000. Child care and dependent care credit is $600 for the each kid. Okay, so that is one thing, and okay, let me minimize this. so these. Okay, so the next topic that we are going to, what is the health savings account? Health savings account is like, which usually you might be eligible if your employer provides a high deductible plans, or if you are like self-employed individual and if you don't have the insurance or like the high deductible health insurance plans, which you can able to deduct, like you can contribute for 7,100, some amounts like 7,000, 100 for this year, 2020. And that is actually, you can able to contribute to your employer. So separately other than the employer to HSA health savings account. If your employer provides, and then you can also contribute with the HSA health savings account to the employer too. That's eligible. So this is, you can able to use for the future health benefits for the health savings account, that you have to use only for the, whatever that contributions that has to be used against health or medical expenses only for that, in order to avoid the penalties. And there is 2 things which usually most of them, they do confusion about what is the health savings account, and employer sponsored flexible spending account also has like FSA, which is a health savings account. They do call sometimes health savings, which is called medical FSA. So that's these employer sponsored flexible spending accounts are kind of like use or lose kind of amounts. So that means just which is a dependent care flexible spending account, and then medical flexible spending account, which is employer. That's if you have like some of them they do mistake, but everybody is now they are aware of it. Dependent care flexible spending, it sometimes if the husband or wife, like taxpayer spouse, if the taxpayer contributes for the different dependent flexible spending account for $5,000, and the spouse cannot again contribute for the same another $5,000, but either ones, but it has to be the total up to max 5,000. They can contribute, either spouse or taxpayer, for the dependent flexible spending account if the employer sponsors that one. And but that has to be, that is kind of use or lose kind of money. And if you don't have, if you don't get the child care services provided for your child, and all that can be like, that's one. But for because of the COVID, there is like a little bit exception that they can use up to the March 31st of this year for 2021, those benefits. But if it is not, then can be like, it will it will get expire, then you might lose those contributions that has been done already during the dependent flexible spending account. Same thing, medical FSA, they did like most of the companies, they did like rollover to the next year. So that means 2021 you can able to use if you are unable to use in 2020 for the medical FSA. So this is one of the examples for the, because everybody has some questions about the dependent care flexible spending account. If this contributed, but if the daycare centers are closed and they cannot able to send their kids and all like the kids are work from home, I'm sorry, I'm like remote school, everything. So they cannot able to like, they don't have, they don't have expenses to spend or claim that one. But sometimes, there might be a chance, some of them, there may be their aunt or uncle or someone, they are taking care of them. So if you paid them cash or something like that, and you might be, or you can give them the some kind of like the W-9 form, take the W-9 as a dependent care from them, and then so if you paid them for the services, even though they are at home, but I know you have to work remotely and all most of the times, and then you will be in conferences, meetings. But they might, so somebody is taking care of your kids at home, you can still pay. If you paid them, give them the W-9 if you are not already given. And but they have to make sure they are filing on their tax return because you are given the money to them. So they have to report in this thing. So that's kind of like they can able to get that in other reimbursements, mostly if it is in that scenarios. So the other thing like college savings plan, 529 plan, that's only for the state. Mostly the state savings, if you are in New York State, then whatever the tax rating, if you are planning to contribute, the max is 10,000 for the limit. Even though if your spouse, 2 kids are on this one, for the each kid is 5,000. But even for the spouse and taxpayer together, the total is 10,000 if you have 2 kids. That's a max. And again, so that's only applicable to the state for the exemptions. Yeah, this is most of the recent common, it's there from 1996 and all, but it's most of the FBAR reporting, compliances and reporting, that is, it's pretty much easy. Everybody can do their reporting by themselves, and they can just go to one of the websites called fincen.gov. So there is, I'll just share my information just about that. Usually what happens is that FBAR means if there is more than 10,000 on aggregate US dollars of 10,000 or more in aggregate at any day of the year in the calendar year in the last year or the previous, the last year, then you have to report the next year the tax due date, which is not with the tax returns, but you have to report them separately. So it's pretty easy. All you have to do is just go to the website and then just fill your name information, and then all you have to provide them the bank name, routing number, bank name, account number, and the bank address. What was the highest dollar amount that you had in the account in the past year? So that information you will have to fill it in there. That's all. You are not paying any taxes on the reporting form, but any interest, as I mentioned, the global income before. So like if you get like receive $10 or $15 interest, even the NRE, NRO, whatever the account, or the non-NRO, NRE, other accounts, anything savings, anything like that. Just you have to report that interest on your personal tax returns as the interest income. So that is one is important. Might be forgetting or I don't know, but that's one of the important things to be aware of. Then the other thing is the form is 8938. That is So that's, let me show you a little bit. Everybody looks like to me, a lot of people, they are aware of, they are afraid of their bar. So just, I'll just go to the one of the website. It's fincen.gov. It's okay, it's at fincen.gov, and then there is a report in FinCEN extensively open. So e-filing, right? We'll just go to the e-filing here, and then it will lead to the website. And from there, we see the e-file bar now. Just click on it, and you can able to download it. You can able to download, prepare, download, and then or you can do the file online bar, prepare and submit. Just I'll download, and then I'll show you how the form will look like. Yeah, this is actually, I need to upgrade this system. I'm using some other laptop right now. It's not that. Okay, so basically on this one, this right, only you go there and you can just all as I mentioned before, your name, address, and the bank name, address, and reporting, like all the what was the highest balance amount in that bank during the year. I like that if you have like 10 accounts, 5 accounts, so just report all of them. So so the another form, which is form 8938, which is also like a specified financial interest on this one. This one has to be filed with your regular income tax returns. So if you have like more than 50,000 at the end of the year in any, like the foreign banks, foreign financial assets, not only the banks, which I forgot to mention, not only the bank interest, bank accounts, you will have to, even for the FR, you have to report all your liquid assets. Liquid assets means not the fixed assets. You might be aware of the liquid asset. Liquid assets means like all the stocks, mutual funds. If you have any in the foreign accounts, those has to be reported too. And so which is like all of those, everything like whatever that is on the liquid, that means you can able to just cash it immediately next day or day, same day, like that. So that, but for the fixed assets like the real estate and all, you won't able to cash it right away, right? So that's not a part of that. Even life insurance uh, premiums, that cash values of those can be also has to be reported. Same thing applies, the same thing on for the form 8938. This is 8938 is, it goes with your personal individual income taxes, which is 1040. With that, along with your tax returns, is 50,000 or more, 50, then you have to report at the end of the year all these liquid assets aggregate value at any day of the year, of the calendar year of the previous year. Example, as I mentioned again, so mutual funds, bank accounts, cash, savings, checkings, or like fixed deposits, anything like that. So that is has to be reported here. The interest has to be reported on the 1040. But some of them, they say they might be questioned that, or they might be paying some taxes in the, for the income they receive from the other country. And but how do I report the taxes here? Because I'm reporting the income only, but I'm paying double taxes, that country and this country, both yes, also. That's most of them, they might have the question on that one. So because there is a foreign tax credit, which is that whatever that, say for example, you have like $10,000 in the bank, and altogether you got about so $200 interest from there, and you paid some $20 there, like some 10% of the $200, you paid $20 tax already there, and you got the 200, but when you are reporting in the US 1040, then you will be paying whatever the tax rate you are in on the interest. Say you are in like a 24% tax rate and you pay 24% of the $200 will be $48 you are paying. Okay, I'm paying 48 here, but I already paid so $20 back in other country. So what will be your implications? Then we can apply the foreign tax credit, which is already $20 paid there, but you don't get exactly the 20 out of 20 for the foreign tax credit. There is some calculations. So you might be almost, you get less of the $20 than you pay the remaining $28 to the US. That's how on the when you are reporting the interest income other things. And also this one, because I'm here, I can explain. I will tell you one more important thing about the foreign things. Most of the questions I get from the clients. So that's okay, I have the asset in there and I sold it, and then so then I have to report it here or not? How does it work? As I mentioned, the global income has to be reported, because when you pay that, like if you file that you sold the property, you paid the taxes already in that country, you are required to file the taxes on the other country, or required or not required, but based on that, if you file already the taxes on the other country, then you foreign country means so foreign then you paid the taxes on that amount on the gain of the natural, but we'll calculate whatever the long term or short term or that like the asset that you kept it, how much if you are using for primary, then there is a calculations. Primary, then there is an exemption, but not on the primary home. But usually, if you are here, then it's not it might be the vacational or a secondary home in foreign country. So in that case, if you whatever the gain that you paid the taxes over there, the taxes can be offset on the federal here as a foreign tax, not the entire amount, but after the calculations, it applies for the foreign tax credit again here too. Whatever the taxes you paid over there, and then it will be taking that credit of it, and then remaining will be paying. And also, most of them, they might have questions. Okay, I bought like 15 years before, and now I'm selling it, and I got like a lot of gain on that one. Then there is a different calculations for the here to there. But in India, say for example, in India country, they calculate based on the inflation rates, and then you pay some taxes over there. But when it comes to here, and you pay that that whatever the difference, but when it comes to you will be calculating dollar to dollar. But 15 years before, whatever this money that you purchase cost is the dollar value, that time you have to consider when the conversion rate based on the yearly average rate given by the IRS, or actually that date that you purchase the cash on that one day. So that is one of the things that which might have to be considered in the future. They are usually, but the federal, we can apply for the federal tax like foreign tax credit, but when it comes to the state, there is no exemption, that kind of like for the state taxes, that whatever the gain you have to pay for the state tax too. But yeah, but like those they are in Florida, Texas, they will get some advantage. No need to pay for the state that time. That is one of the things that might be like questions that usually I get from the clients. Then any questions? I'm sorry, I'll come to the question and answers at the end. So that further before I go to the business, business taxes, I would like to show one of the. I would like to show one of the thing which is the same. Okay. One of the Schedule C, and before I go to the business taxes, I would like to share one of the information that for the income, like most of them, they might be aware of the self-employed income, right? So that I will want to show that as how that form looks and how to report and all. So this is the Schedule C, is a self-employed business profit and loss from the business. Okay, that's about like $20,000 if they have the income, and then they might use some expenses, like for the office they have to use for the office expenses, they something they have to buy for the office, those are all the kind of expenses. And then for the business purpose, they use their vehicles, they use for that, how many miles they have to keep, whatever this mileage, these are the approximate numbers, just giving you a scenario. Okay. Then they might have to use for some repairs, supplies, or utilities they pay. The net after the expenses and everything, it comes to be like 13,500, right? So they pay the Social Security Medicare tax on this one if they are not already reached to 135 above 137.5 income. They still have to pay Social Security Medicare for the 15% of this amount and whatever the tax rate they are in for the federal. So this is how this looks like. And another form, like a couple of them, they wanted to show you about the rental income expenses or the rental income. So you have like two other homes, and say you have like the old home that you are using, that you you got the new house and you went there and you don't want to sell the old house, then you wanted to use that for the rental. And then probably everybody thinks that, okay, if I get the rental income, I have to pay the entire tax on the rental income, but not that on the rental supplemental income losses scenario. So that is if they get like some 20,000 as a rental income, so they might pay some insurance for the house that is deductible for the rental properties. So then they pay some mortgage interest on the house, and they pay like taxes on the house. If they pay like 2,000 or 5,000, whatever the tax they can able to deduct, and then if they have to pay in utilities from their pocket, even though some heating, some places in the New York City, the heating has to be provided by owner. So that's when that case the utilities that you pay, that means you can able to deduct those. And the net is, and the depreciation expense. The depreciation is a little bit hard to calculate for you, but this is like if you're placed on that service, usually the straight line depreciation is 27.5 years for this single family. And these one houses, that this is based on 400,000 approximate. So they can, this is for the year. So they can add it. So then total expenses, it came to like 29,640 here. This is an example. And because their income is only 20,000 as a rental income, then you still have they are in the losses, right? So, so that means if their income is 150 or less on their total income as adjusted gross income like this, now 150 or less. There is some calculations, but I will tell you if anything is that you can able to. That's you can able to write off that license. The rental income losses on your regular income of this one. If they're like certain income and high, they are not able to withdraw that. Deduct the losses in their income. And also, if you have like another rental property manager or anything for the rental property, then there is a limitations on that one to deduct losses on that one. But the main information that I wanted to pass on this one is that most of them, they think that, okay, I have the rental income 20,000, I still have to pay the entire 20,000 income in like taxes on the entire 20,000. That's not true, but you can able to do some like expenses on the rental income. So most of the cases it might nullify unless it's like depreciation is not there or like there is no mortgage something. But this is an example for that, for the individual taxes. So So the business taxes, right? So the corporations, everyone, oh, I'm passing the time. Okay, just have to speed up. Okay, the business taxes is mainly the corporations as corporations, limited liability companies, partnerships, sole proprietorship, self-employed individuals. So most of the corporations, but is like, they are 21% tax rate until like, whatever the enacted timeline. But right now the corporations, they pay double taxes, right? That means they pay tax on the corporation and also pay tax on the dividend income that's been distributed to the shareholders. So that's where they call it as a double tax. So if they keep it dividend certain period and above, and they distribute the dividend like shareholders, then it's called as a qualified dividends. There is a less implications, like impact on that one. I will explain that later. So the S corporations is one of the important the thing, like there might be like most of them is like that's only the limitations on the S corporations are like 100%, 100 max 100 shareholders, and all the S corporation shareholders supposed to be US residents. That's one thing. And then limited liability companies, one member has to be managing member, that is called general member, and the rest of them can have like limited members on that. And the partnerships and the show, that is like multiple partners that can join together and form a partnership. The share, like they can always partnership agreement, they make it as a percentage, how much like the profit percentages, capital contribution percentages, like that, everything they do. So this one for the sole proprietorship is the individual, he owns for the entire company, like for the entire, as previously I mentioned, showed you for the Schedule C, which has like all the income expenses that has to be reported in there. Like self-employed individuals, like the same as the, but sole proprietorship have some, they can able to open up like business name registered with the state, county, and all. They can able to, they get like separate EIN number on the sole proprietorship and with the business name. That's called sole proprietorship. Self-employed individuals like freelancers, then they could do, some of them they work on 1099. Independent contractors, they work on that. It's called self-employed individuals. They report on the Schedule C as income expenses on that one. So these are the one. One of the item for the S corporations that I would like to give you more details. Say, for example, why should I do for I'm the individual? Why should I open up a company and all? This is like some of them, like if both employ, both wife and husband, or like taxpayer and spouse, they are working on the both working on the W-2s. And but what happens is that if you one of them, they work on the 1099, and based on the like corp to corp basis or something. One of them, they might be, if the job is stable and then the long time they don't want to go for the 1099, and they stay and they get a lot of benefits from the employer, like health insurance and 401ks and everything. So they get it, and then job is safe, then you can able to continue. But if there is a chances to get on work on the 1099 or corp to base for one of the thing, and is of course job safety is not that much on the when you work on the 1099 compared to the W-2 or the companies. But you have to think about it. That's important thing for the job safety. But if there is no safety, like something, then you are just they are giving you W-2. There is no difference from 1099 to W-2 if you are working for that company. And if there is a chances, if they give 1099 to you, so and if you are like citizen green card or resident alien, when you are working on that, like there's EID, that working on the EID, then you might be eligible for the S corporations to form. And so if you actually say, for example, if you take Now, if you are working on the billing rate, say $50 or $100, that depends, increase. So I just give like some scenario for $50 scenario, right? So, for example, if they make like $50, 106,000, the approximately for the year they get. So they get like say I'll take just $70, right? So that means close to that they get 150,000, so close to 140 or 150. So from there, what they do, like they for as corporations as an officer, 2% more than shareholder, there is a requirement for the you have to take the payroll from the company. So if you take the payroll, that's a minimum standards for the industry standard for that your job. If you take about like say 60,000 or some 72,000 on that one, 72,000, and you run the payroll taxes, even though if you work on the W2, but the employer pays the employee taxes. But in S corporations, that if you work for yourself, you have to pay employer taxes also yourself. Usually they might give like 10% more because of the car to car, because you are bearing all the employee taxes too. That you have to work with the employers because of the contracts and everything. If that is eligible, this is a scenario only I'm giving you. Then what happens is that if you work on that, the spouse, you will get, say from spouse, you will get all the benefits, medical benefits and everything. So instead of like for you full time, if you take another medical benefits, all of them, instead of that, if you take 1099 opportunities, if they pay more and job safety is not that important, then you can able to switch to that and then take that. So you might save almost like much in taxes itself on that scenario, because they give like some, you have to run the payroll, minimum payroll on this corporation as per your job requirement, and then remaining you can take as a dividends after the expenses on the company. And then dividends is only taxable for the federal and state. You don't pay self-employment taxes like 15% Social Security, Medicare tax, almost close to 15.3. So Social Security, Medicare taxes, you might save something than that to think of for the S corporations to go. Like for 150K on the net income, gross revenue on a corporation, if you have like some 75K payroll, then you have then 75K, and then but when you pay, you have to take the remaining 75K as a dividends. But you might have some expenses that related to the corporation that you have to use for the business, some business formation, or like all the other expenses related. If you have like some 10, 15,000 or 20,000, that depends to justify all the expenses on the required for the company. Then you can minus it, and then whatever the 50,000 or 40,000, you just have to pay dividend taxes on the dividend as a dividends, if that's get distributed as a dividends to the individual, and they pay taxes on that one for federal and state. And on the dividends also, there is one advantage in here. There is a qualified business income deduction. 20% is a QBI. Like this is eligible for all these, most of these companies. That is like corporations, limited companies, and partnerships, and sole proprietors, except the corporations. Corporation, there is a limitations on that one. So that is a qualified business income. For the qualified dividends, they might be eligible for the 20% QBI. So here it is like this is the slide from Internal Revenue Service. That's this is called Section 199A deduction. That's mostly for these partnerships, proprietorships as corporations. So all of these ones, 20% I mentioned previously. So that means in the income, like 150 of the revenue on the company, you pay 75,000, 75,000 as a payroll. Then after the expenses, you get 50,000 as a dividends. On 50,000 dividends, you might be eligible for 20% deduction straight on 50,000, which will be right away. Like maybe you'll be paying only taxes on the 40,000 onto the federal. So that means having the business as a corporation, you might save almost like the net. If you on top of it, instead of W2, the contract they might pay 10 to 15% that negotiation with the contractor. This one, and also on top of that, you might say, but if you work on W2, then almost if you look at the net pay on the W2, 40%, 40 to 45% goes on the taxes. That depends how much tax rate you are in, and at least the 30 to 35% you will see less on the paycheck, right? So this is the most of the advantages for wife and husband there, or taxpayers or spouse. They think it's better for them to think about this for this corporation and then how this is. This is one of the does not include any of the QBI does not include any of the following. These are the exceptions like investment items, and then all of them. These are like couple of these items are not eligible, not qualified for the deduction for the QBI. And also there is some income limitation, but everybody thinks that, okay, this is there, then I can able to get it. There is a limitations for that, for the income limitations. Looks like I don't have it. That's about 375. I will give you if somebody calls me that. Okay. um, there are not everyone can deduct, but there might be chances like below 400, so jointly 375 some limits are there. Okay. On that. That's about it. And then on the business is the retirement plans. That is one of the important things that they can think of for the retirement plans. Which work for the another company on the W2, the max you can contribute is 19,500 for the retirement, and also you can contribute the max of like with the whatever the age additional, like maybe if they are above, they can qualify additional 6,500. Massive the contribution for that, maybe up to 26,000 for the 401k through employer. But if it is 50 below, then it's only 19,500. And for this SEP IRA or the self-employed 401k is one of the popular of that one. But if you have any employees other than you for the self-employed 401k, then you are not eligible. The SEP IRA is also something. But this is also when you have like other employees in the company, then they might not be. There is a limitations all of them, so that might not work for you. But if you are just yourself and you are working for yourself as a company on that one, you're running the payroll for yourself. These are the most important the advantages retirement plans that you may be eligible up to like 57,000 or something on that one for the contribution. Say for example, self-employed 401k in the same scenario for 150,000 before the income, then you actually contribute like in 19,500 as an employee on the W2 that you ran. Like an example, I gave like 75k, you can do 19,500, and then on 25% of the W2 wages, you are allowed to contribute. If you have 75k payroll and 25% of that is approximately 18,000 some change, and then you can contribute the 18 plus 19.5, so that means you are almost like 37.5. You will be contributing for the 401k for your retirement, but not eligible on the regular business. So that on the W2. Then this is something which is like what's new in 2020, got it from the slide from Internal Revenue Service, and this is the economic impact payments, which is called the stimulus payments, EIP1 and EIP2. And that's if you know, if no one, like some of them, they have not received the economic stimulus payments, they can able to like claim those in the recovery rebate called recovery rebate credit. So that they can claim using that form that I can show you on the 1040 again. What is that? If they have not received previously the stimulus payments and they are eligible for it. That is that one. And then the charitable contributions other than the itemized deductions, you can contribute up to $300, even though if you don't. Usually, previously last year and the last year, if you do itemized deductions, then only you can deduct the charitable contributions. If you, even though if you don't do itemized, you can contribute up to, you can deduct up to $300 for the last year. If you contributed any of the charitable and then to organizations in the last year, that up to 300. These are the standard deduction amounts probably for the 2020. 2020, the standard deductions for the single 12,400 married filing joint is 14,800. Sorry, 24,800. Head of household is 18,650. These are the amounts. Last year was a little bit less, 24,400 and 12,200. This one something. So these are the ones, some like a little bit new compared to the 2019, and a lot of other new things are there. That's most common, the things that usually we plan. So like for the stimulus payments, right, which is that, most of them, they got it, and some of them, they might not got it. I still see like a lot of calls for me. I didn't receive stimulus payments for the first time. I didn't receive it, but second time I got it. I don't know why. So, but second time, like the first time, some of them, like this is the scenarios are mostly if you are eligible and if you did not receive it, and as I mentioned before, recovery rebate credit, which is that we can claim in 2020 tax returns. Say if you're, for the scenarios like that, say one of the spouse is on ITIN and she did not get EAD or he did not get EAD, then Social Security they might not be eligible for. But one of the spouses in the tax returns having the ITIN, then they did not receive the stimulus payment in the first installment. So they can apply while they are in the 2020 taxes. If their income, like whatever the thresholds, like 150, they provided 150 to 198. The phase out starts after 150, 198, then completely now, but based on the dependents, again, that might increase a little bit more. That's if they have not received, they can apply now as because one of them they have ITIN, one of them Social Security, because at least the Social Security spouse can get like taxpayer can get the $1,200 credit that can be applied in the 2020 while filing the tax returns. If the income is like more compared to the 2019, then they might not be become less or calculations involved on this one. On the other scenarios, yeah, that's a couple of them. We can claim it if they are eligible for it. Yeah. So this is the one, another one. EIDL, which is that the phase 1 PPP, phase 1, phase 2 PPP loan 5, which is the loan forgiveness process. And how do we go about it? And everybody, when I say PPP, then they think only the business. Of course, it's for business, especially for everyone. But the phase 1, that is like most of them, they might not be aware. If you have like Schedule C income and like self-employed, and they might be eligible for the loan too, based on the line number 31, which is of the Schedule C. Let me, okay. So the phase 1, like most of them, they can, like this is mainly the phase 1 they are giving for the payroll, the payroll, and that is 2.5 times the monthly average payroll. They are given the PPP, phase 1, the loan. And then phase 2, if their income is like less than, like, compared to 2019, 2020, income has to be less than 25% of that for the 2020. So I just give like some information about that. So then a phase 2, you have to further. For the phase one, you have to, phase two eligibility will be like, you have to, if you claimed already phase one, the first loan, and then you are already used those funds, and your income is less than 25% compared to 2019 to 2020, then you might be eligible for the phase two. That's a loan for the paycheck protection program loans. And the loan forgiveness process, which you need to, for the phase one, whoever they're already applied for the phase one, they got the loan, and there is a 24-week that's period that you need to use those funds for that, and then so that can be used. And so that's one thing. So, and the employee retention credit, that's most thing which is given for the employers. If their revenue was less than 50% compared to the previous year, they might be eligible for like, you know, the 70% of the qualified wages that paid to keep the employees on there. This is mainly purely for the business corporations, for the employers. So this is one thing that, you know, we just got this today morning. We saw the news for the third stimulus payment, so which House passes the bill, and then so we are expecting that, you know, will go through, and then that's $1,400 for the third stimulus checks. Everybody might be interested for the future income that's coming up, non-taxable, especially those stimulus payments. So what do you want to do? You want to file for 2020 immediately, or you want to wait for that? Tax filing immediately. You still have the time to file it or something. That can think of what to do, what not to do. So that I'm open. Because this is a simple example. If your 2019 income was very high, and so you didn't get the stimulus payments, but you got the 2020 income is very low, then you might be eligible for the full stimulus payments. Then, as I mentioned previously, that you can you can apply for the recovery rebate credit to get all the stimulus payments previous. If you file now for the 2020 fast, then you might be there looking at the 2020 tax returns. Then it will be going to the, you can file for the, so then say for example, in 2019, your income is like 250,000, you did not get any stimulus payments. So 2020, your income is only like 150, the married filing jointly. Then your income, 150, then what happens, you might be eligible for the previous, all the 1200, 600, all the tax. And then now, so that's almost like, 3,600 for the married couple, except kids. If they have kids, then additional amount. Everything you can apply as a recovery rebate credit. And also, if you file now, then future payments also 150 below your income, so you're eligible for the entire payment. The future, like 1,400, you will get also sooner. There might be a chances, even though if you file now late 2020, yeah, you might apply a little bit later if they have like some tool kind of, if they provide your 2020 AG adjusted gross income is lower than this one and you did not get a stimulus payment, there is a chances that you can also apply later. But one thing that, okay, for example, so can you wait for the 2020 tax filing season? When do you wait 2020? Okay, your income 2020 is 250,000, and then your 2019 income was 150,000. You are eligible for the full stimulus payments, and you got all the stimulus payments. And now, your then what happens? You have to. So when you are 150, then you actually in the 2020 your income is 250. 2019 you got all the payments, right? So based on the stimulus check, the third round stimulus checks, which is they are looking, if you don't file 2020, they are looking at 2019 returns. So then if you are 2019, you are eligible for it. Okay, let's wait for 2020, but don't wait too long until April 15th. You might end up paying the penalties if you owe the taxes. And or you have to file for extension, pay the estimated tax payments, and probably even wait if you still not receive the stimulus in that case. I think thank you very much everyone for giving this opportunity, representing. There's any questions? I know it's sorry it took a little bit longer, almost long time.
Okay, thank you so much, Shekhar Garu. It was a great presentation. Detailed ga anni forms chupetti maaku walk through chesaru. So let's take some questions now.
Okay, sure.
Okay. The first question is, I have 401k from my employer. Can I still open Roth IRA?
Yes, so that depends upon, there is some limitations on that one. It's like a Roth IRA, but there is they might be eligible, but there is some limitations for the income limits. I don't know how much that depends.
Okay.
Yeah, they might be eligible, completely చెప్పలేను, but I have to look at their tax returns.
Okay, personal. Okay. So how to open a Roth IRA account? Okay, a similar question. How to open a Roth IRA account? Am I eligible if I have 401k account? Yeah, same question. Yeah.
Then they can.
All right. Okay.
That's usually what happens is that they might open the traditional IRA and traditional IRA open చేసి మళ్ళీ ఇమీడియట్ గా రాత్ కి కన్వర్షన్ చేస్తున్నారు బ్యాక్డోర్ IRA అని చెప్పేసి. సో దాన్ని లేకపోతే ఏమవుతుందంటే మనం తెలవకుండా మనం ఓపెన్ చేసేసి కాంట్రిబ్యూట్ చేసామనుకోండి. సో కపుల్ ఆఫ్ థింగ్స్ ఏమవుతాయంటే they might end up paying 6% penalties for keeping non-deductible or non-contributable IRAs, because I don't usually suggest unless I see all the returns of their information. So
okay. Next question related to FBAR Andi, like Venkat Garu from Seattle is asking, money transfer to parents back in India. If I send 10,000 or more to India, do I need to file FBAR as mandatory? Please advise.
Okay, so as I mentioned previously, the FBAR, if you have any accounts, the accounts are, so if you have any accounts in India or foreign countries, then you are required to report. If you are sending for the family maintenance for something that not going to your account, so you don't have to report the FBAR. If it is going to your account, that means you have the funds available in your more than 10K on your funds. So what is the purpose? Doesn't matter. If the accounts are owned by you or by joint with someone, and they have the funds more than aggregate amount more than 10K, they have to report it on all the accounts.
Okay.
So that's a question to them, is like whether that's is a joint account they are sending to amount, or it's like where like, you know, if their name is there on the account, then means they have the funds in there, right? So they have to report it, unless the funds are going to the other account. But one more thing that they have to remember here, in the US, whoever they pay more than $15,000 to the family or others, and they have to pay the gift tax, right? Up to like a year. There is a gift tax implications too. Then if you pay more than certain, even if you pay for your kids or parents, anybody, like the gift tax implications are there. Just you have to be aware of those. Yeah.
So what if I didn't file FBAR for past years? Should I, or can I file this year for past years also?
Oh yeah, they can correct it all the time. Yes.
Okay. So what is the criteria for PPP phase 2 eligibility?
The phase 2 eligibility, the mainly as the funds has to be what if you got the phase 1 loan already. So that means if the funds that used for already for the required the usage, that means for the payroll purposes or the utilities that is required as a mandatory when we are applying for the PPP phase 1, there are certain rules. They have to use those funds only for the payroll or the rent, some of them for the rent, some of them, that depends upon the like the utilities and all. If they use the funds already or they before the funds will be used before the second loan gets approved. So that means or approved or before the second loan, they expect it to be complete use those funds, and then revenue has to be less than 25% of the compared to the previous quarters of the previous year. One of the quarters of the previous year, 25% less, 29 to 2019 to 2020.
So another question here
and
is.
There are like a couple of other implications too, but most of them, that is a common things that is eligibility for the phase.
Okay. So another question here is, I have SSN, but my spouse does not have SSN, but ITIN. Am I eligible to claim first stimulus if I meet income eligibility?
Oh, yes. They are eligible. That's as an example scenario. I provided that on the things that because the spouse does not have the social security and taxpayer has the social security, ITIN, the spouse, like taxpayer is eligible for the first stimulus payment, $1,200. They can apply using the recovery rebate credit, which is on their tax returns itself. That is called the credit called recovery rebate credit. That's $1,200. They can apply.
Okay, I'll take some questions from Facebook now, Chandrasekhar Garu. So, our matured life insurance policy amount from India is considered as foreign income?
Mature income, yeah, that's obviously global income, right? So, if they are filing the taxes in India or some other, yeah, that's mentioned that. So that's if they paid that. That's actually the income, right? It's like from the savings, yeah. Yes, it is.
Okay, another one, employee retention credits. What years or quarters the income is compared to?
What year and quarters? That's for the 2019, it has to be less than 50% for the previous quarter of the same quarter. Less than 2019. If they are, say, the 2020, for the if the employee retention credit, which if they say for 2019, if they have like say 200,000 income, right? So then if the 20 in the first quarter, 200,000. Same 2020, if the income is 50% less in the first quarter of the 2020, I'm sorry, second quarter, it started from second quarter of 2020. So they give the credit for that one. The date is just prior to the second quarter of the, did not remember the date, but it's first is just prior to the second quarter. So they can claim that after starting from the second quarter of the 2020 and the quarters, if they, for example, 200,000 in the second quarter of the last year, like 2019, and then 50% less revenue on the same corresponding quarter in 2020, then they might be eligible for the employee retention credit for the taxes they paid.
Okay. So the next question, can I send $14,000 each to my father and mother totaling $28,000 and still avoid paying gift tax?
Yes, because you are paying to the two different individuals, yes.
So do we need to pay taxes for the stimulus checks received?
No, it's not taxable.
Okay. Who are on student visa, can they be eligible for stimulus checks?
No, that's a non-resident return, right? So that's the same thing like TTA. Okay. So that means like they file a non-resident 1040 NR. So they are not like a US person, then they are not eligible when they file 1040 NR.
Okay. Is there any difference between FBAR and FATCA?
So yeah, FATCA is the one which is, I mentioned the form 8938, which is a specified financial accounts that need to be reported on the personal tax returns, that form. And so is the FBAR has to be reported to the FinCEN.gov that I showed that.
Yeah. Okay. So money received from India, do we have to report them in tax filings?
So what type of money, like as I mentioned previously, global income has to be reported, right? If it is more than $10. So, so is the money that is coming as a gift, or it's coming as a, so different scenarios. If it is income, it has to be reported as a $10 amount. So the gift implications, I mentioned that, and then the gift payers will pay the gift tax. So that's.
Okay. May I know how much maximum amount of eligibility for child care tax credit?
Child care tax credit. So that is the maximum. That's the $3,000 for the each dependent deductible, and that means 20% of that is $600 for each dependent child care credit.
Okay. So who will be eligible for itemized deductions?
The itemized deductions, like, okay, that's a good question. Let me share. It's a big topic. Okay, 1 second. I'll just show the same. Okay, I didn't put the. Okay. So yeah, there's I found here. It's a big topic. Like, yeah, pretty much. I'll just open up schedule here. I'll just explain. So you can able to see my screen.
Yes, Andy.
Yes, okay. ఇక్కడ మనం ఏంటంటే జస్ట్ మెడికల్ డెంటల్ ఎక్స్పెన్సెస్ ఇవన్నీ ఉన్నాయి కదా టోటల్ గా. సో ఇది మెడికల్ ఎక్స్పెన్సెస్ అండ్ డెంటల్ ఎక్స్పెన్సెస్. సో దే the primary thing ఏంటంటే whether they are eligible or not, that's స్టాండర్డ్ డిడక్షన్ కన్నా ఎక్కువ ఉండాలి 24,800, which is married filings joint. అదే ఇండివిజువల్ ఏమో 12,400. So which is further, it has to be exceeded more than 12,400, and and for married filing jointly, it has to be 24,800. For head of household, it's 18,000 some change. It has to be exceeded for those amounts in order to qualify for the itemized reductions. So in the itemized reductions, there are a couple of things, right? In the medical and dental expenses, there is a cap on that, like the 7.5% of adjusted gross income. In the previously, which I showed that return, that's for 150, the 7.5% approximately, which comes around like so 10,500 something. Up to that, they cannot able to deduct it. It's more than, say, if they have 15,000 here, and then so expenses altogether, and the 7.5 is only like 10,500. So the remaining comes 4,500 here. So that's a medical expenses. And the other thing that there is a cap on the state and local income taxes. The max they can deduct is 10,000. This is called SALT. Say, for example, if they pay on income taxes, everybody pays their state taxes or anything. Like if they have like 4,500 or something, $5,000 as a state and local taxes they pay. Sorry. And then real estate taxes, that if they own the house, and so they might be able to claim that expense, like whatever the property taxes on that they're paying, like maybe say $7,000 they paid the property taxes, and then some other that some states there is eligibility for the personal property taxes, like Connecticut and like Virginia and some other states they have like they pay taxes on their cars and everything. So that's other thing. So that's not applicable to New York here. And so if that is the case, if the total is like 12,000, but here, yeah, then the 12,000, but they can able to take only 10,000 as a deduction on all of the sum of all these, the max limit. So if they pay the interest, mortgage interest, if their house, they pay mortgage interest about $8,000 for the year. Then this comes to be if they pay like a mortgage insurance premium PMI, if the 20% are less than the mortgage, I mean like the equity on that one, usually they charge PMI, a mortgage insurance premium. That may be if they pay like, but this is only limitations. If their income is more than 100,000, PMI is not deductible. So if the income is less than 100, that's the one. So if they say, for example, everything this came out to 8,000 here, and then their charitable contributions may be like $500, like here, and then some $500 for the clothing drop-offs and everything. So if they have it, so that's about like $1,000 here. Then still, when you add up total, which is like 4,500 medical expenses excess to the 7.5% of AGI, and then here like 10,000, 4,500, and then total this add up everything, so 919. So since 23,500, still the total is 23,500, which is they are not eligible. So this still this one. But what happens for the New York? Yeah, in this case, 23,500. They're not eligible for itemized deductions because anyway you can take 23,500 or 24,800 as a standard deduction for married filing joint. But usually the married filing standard deduction is higher. We are always elect to take standard deduction because this is lower than that. We'll get the tax advantage. But you're still able to do election to do itemized if you want to because you get less something. So that's the difference. But this is the same case, but for the state, right? State you can able to do itemize in this case, but for the state is only 14,500 is the standard deduction for the New York state, only if I'm taking only for the New York state. Then in that case, everything is exceeded in the state, but only this one is not deductible. $500 is not deductible for the state as the state income taxes. But this $700, $7,000 is deductible as a property taxes, this mortgage excess, this one, and then 7 plus 4,500, 11,500. Mortgage interest rate about 8,000, which will be 19,500, and the charity is about like $1,000, which is 20,500. You can able to deduct on the state as an itemized reduction, but not on the federal. For the New York state, I'm talking about. Still they can elect to do itemize on the state, but not on the federal because it's not advantageous for them. Any other questions?
Yeah, thank you for the detailed explanation, Chandrasekhar Garu. Yeah, there are a few more questions. In regards to getting money from India, we sent 10,000 earlier and would like to get the same amount back now. Do I still need to report this during tax filing?
So it's not, okay, it's kind of like that means you are lending money to this someone and you are taking money back from them. It's like a loan thing. So as I mentioned that previously, the loan is also consider your assets, liquid assets. So you can able to take that as a back. So the loan, you are lending the loan means you have some cash assets are there. It's like a short-term capital. So that is kind of requirement that you are lending loan to someone. That means you have the cash assets there, not like the fixed asset, but you have like not the accounts receivables. So that means it's a loan, right? So you're given to loan, but you can able to. So that's kind of like reporting requirements here for the loans.
So I'll hand it over to Sunil Garu now to continue with the questions while I look for some questions on YouTube and WhatsApp. Sunil Garu, please go over.
Yeah, Shekhar Garu, thank you so much for the valuable information. Now I have one question, Andy.
Okay.
If we have fixed deposit in NRA account, should we file a tax or not? If yes, where should I file?
Okay, fixed deposits that you have the interest income there, right?
Yeah, in NRA account, yes.
Yeah. So as a global income, if it is more than $10, then you have to report it. Yeah. If you pay taxes already in the other country, that we can get as a foreign tax credit exemption on the to reduce your taxes here.
So one more question, Andy. What are the most common deductions and credits can I claim?
Common credits and deductions. So for the W2 income or like business income, what type of income is that? Like for the W2 income is like.
Yeah, W2 income.
So W2 income, like most of the deductions means like those that we discussed about the credits, which is a child care expenses credit if they have children. But the other than that, the charitable contribution here, if you see that line 10B, charitable contribution, this is about $300 that if you pay charity that can able to deduct from here. And then all the deductions which goes pretty much here on the. Okay, sir, this is just sample information. I'll just go back to the previous question that they're asked about. What are the
deductions, right? Common deductions and credits, right?
Yeah, the credits and all.
Right.
Okay, so these are like when we see the common credits, we see here non-refundable credits.
Right.
Non-refundable credits, which is like credit for the child and dependent care credit, which is the form which we discussed, 600 for the kid, max $400 for the tickets, and then education credits, which I discussed about the previously, which we can go like the American Opportunity Credit or the lifetime learning credit, and also that. I mentioned the tuition deductions, we can deduct up to that. And the other retirement savings credit that is based on the age limit and all, and some residential energy credits with the form 5695, and then that's pretty much it, like pretty much for the deductions on the credits and all for individuals. And so which I mentioned previously for the if they did not receive for the recovery rebate, which is that 7, which they can use line 30 if they did not receive the some stimulus payments if they are eligible for that in the previous year. That's pretty much it. Unless there is a specific item, I can elaborate.
Yeah, that's okay. If they want, they can contact. Anyway, they can contact you. So, right, there is a contact number on the bottom, so where you can reach them directly.
Sure.
Because everybody has their own different income, right, sir? So,
Right.
So it depends.
Right. So,
yeah,
I'm sorry. I'll take the next question.
Yeah, I think most of them is covered. Like somebody asked just now, what is the difference S-Corp and S-Corp versus C-Corp?
Oh yeah, the mentioned which is a C-Corp is a double tax which you have to, that's the fixed tax that you have to pay on the net income. Say for example, you have like 200,000 revenue and you have like 100,000 is the net after all the expenses. Like only if you have 50,000 expenses, and then you take some payroll for yourself as an officer's compensation, like 50,000. Then you have expenses 50,000 officers compensation. Then you have net profit of 100,000 from 200. On 100,000 you pay taxes on the corporation level, which is say like 21% on the 21,000 you pay upfront on the corporation. Remaining amount, which is like 79,000, is as a retained earnings. Retained earnings you just keep in the corporation, or you can distribute as a dividends to the shareholders. But when you distribute that as a dividends to the shareholders, and you will be taxing the shareholder taxing again, like taxed again on the individual income on the dividends, whatever the tax rate they are in. If their tax rate is 24% or 28% or 33%, then they pay tax on their income, that tax rate. That means it's called double tax. And double, you are paying on the corporation level and also you are paying on the individual level. That's a C corporation. Same scenario, you have like 200,000 is the net revenue. And as a shareholder, if you are 100% shareholder on the SES corporation, then you just take as a first compensation, but you have to run the W2. But there is a minimum tax, minimum wages that is done based on your profession. Say if you run 52,000 or something, or instead of like 50,000 that you have officers compensation on the C corporation, but you might have to invest standard. You might have to increase, say if you have 70,000 on that, run the payroll for 70,000. Then you have other expenses that, the same expenses that you use 50,000 on the C corporation, same thing you can use on the 50,000 on the S corporation as an expense. Then will be net income after 70,000 salary for you as an officer, also deducted as expenses on the S corporation. Then what happens? Then you will get 120 total expenses. Then you have remaining 80,000. 80,000 will be distributed to 100% shareholder if you are 100% shareholder. So this 80,000, see, you didn't pay any taxes on the company, on the S corporation as of now until the 80,000 that you didn't pay. But unless there is some state, you have to have minimum franchise taxes and things. If you are a city, there is no exemption for the New York City, this corporation, or this. I'm just generally talking about the federal level right now. But they that's on the 150. That means the net income came out after the 70 payroll and then 50,000 expenses, 120K. After the 120, then 80,000 is the net income came to your personal as a dividends. That means it is reported on Schedule K. Schedule K, which is that, and if it is qualified business, which is SSTB or some specific things up there, if a qualified business on 80,000, still you are eligible to deduct 20% of the 80,000, and you'll be paying only the remaining tax on that 80,000 as taxes. So that means 80,000, 20%, you take off 16,000, you'll be paying 64,000, taxes on 64,000 as an ordinary income on your regular tax return. So you will be saving like a lot on the S corporation compared to the C corporation, but this is not a big, right? So if you have other employees and all, so then you have to think about it like when, the salaries and everything. So that's one. So usually, yeah, that's it. To avoid the double tax, and they form the C corporation, S corporation. And as I mentioned before, for S corporations, they have to be 100%, the all 100 more than, cannot have more than 100 shareholders, and all the shareholders have to be US resident. That's a primary, but there are a lot of others. But most of the things that is important things. These are the two items for S corporation.
Okay, sir. Thank you so much for the valuable information. And there is a last question, I think, from Kishore Bodapotra garu. Kids receiving the gifted money from the grandparents, does this have to be deposited in 529 plan, or can we create a bank account on kids' name and deposit them? And does this has to be notified and on our tax filing?
So if the grandparents, they are directly contributing to 529 plan, that's multiple questions. The couple of things I need to go about it. But usually when they're gifted, right, they can contribute to gift when they give. less than 14,000 something. But most of them for the education, if they give the gift, this one, that's not required to report less than 14,000 per year. They can deposit that for one 529 plan. But if it is that contribution is not deductible more than 5,000 per kid on their tax returns.
Okay. Okay. Thank you, sir. I think I'm done with my questions I read out. So, Vani, if you have any questions, like you can continue, Vani Garu.
There are a couple. How to open traditional IRA?
Most of the brokerage firms, they do support the traditional IRA model. Most of the banks, like whatever the bank they are with, they can go with them. Like one of the popular one I see, the Fidelity, which is the one which is they offer like more support, also customer service and all for the information. They are like very much good at all the retirement plans, accounts, and everything. They give like some position. That's one. But there's a lot of others. Most of the banks, they do offer for the opening the traditional IRA account.
Okay. So probably we covered this already, but how much maximum tuition credit we get for a child?
Okay, tuition credits, there are like a maximum, that's a 2,500 for the American Opportunity Credit, but that's not eligible for everyone. As I mentioned, American Opportunity Credit is only for 4 years undergraduate students for the first for 4 years for the undergraduate students. For the maximum they can get is 2,500 for the education credit.
Okay.
Lifetime credit, which is $2,000. That's so 20% of the tuition payment.
Okay. So I think we pretty much covered all the questions from all the platforms.
I think, Vani, there's one more question.
One more? Okay.
Yeah, Vani, this is Malik. I think there was more question in the
Please
chat.
go ahead.
That is, any changes or benefits we can take advantage of during these COVID times?
So that's, we covered the PPP, right? So that's for the individual. Mostly, there is I mean, like for now, going forward, except there is one topic I wanted to cover. Same thing. Okay, so I have to. Oh, one second. So one of the things that I mentioned about Schedule C, which even though most of them, they might not be so aware of what for the Schedule C for the Paycheck Protection Program, they might be eligible for that, the 2.5 times the monthly average payroll. So when for the self-employed or sole proprietorship, they go, even for the single member LLC, they go for this number here. That goes like 31, line number 31. So if the line number 31 is like 13,500, just, maybe just this example, if they have like 100,000, then divide by 7.12, then it may be like 8,300. But the max is they given the cap for the monthly average payroll is 8,300, which is for the math 100,000 cap for the year. And so they can go up to 2.5 times as this much monthly average payroll for the eligible for the Paycheck Protection Program. Even that lapse on March 31st, they might be eligible up to March 30th to submit that, even for the first Paycheck Protection Program. And so this is the Schedule C, the line 31 divided by 12, then multiply by 2.5. Even they make like, this much, like, 5,000, 6,000 self-employment income, they might be eligible too. Maybe they can get like $1,000, $1,500 the loan. If they use that amounts towards the payroll again, they might be eligible for the forgiveness for those loan amounts. There's the last chance until March 31st for that. And other thing for the dependent flexible spending account, that's most of them, they did not use it. If they have not used it, and which is for the dependent care flexible spending account, if they got provided services from like family members or anything, but make sure they have to report it in their returns too. They can if they paid some amount already, and they can also claim that on their through the employer, not on the tax returns. But again, it's taxable. If that is not used that on that one, they have to pay tax on that amount. Though for the dependent flexible spending account, it's kind of, even though they lose it, again, they have to pay tax on the individual income taxes on those amounts. Most of the, which is that flexible spending account for the medical, which is already rolled over to the next year, 2020 contributions are can able to roll over to the 2020 if they are not used or not exhausted. So they won't lose. Those are use or lose kind of money, right? So that's, they have to be more careful when they contribute to that flexible spending accounts on that one. And for the stimulus payments, that what we discussed for the future, that whether you have to file or you don't want to file, or you have to wait for it, something which discussed. Okay, the last one. So that's the thing. That, as I mentioned, for the employers, the employee retention credit, and that's pretty much it. Even from the what's new on the tax returns, kind of. Yeah, nothing. I remember anything else right now. If you have any specific questions, I can answer.
There's just one more that I just received. If I did not receive the stimulus checks, how can I claim that?
Okay, that's I'm right on the top of here. Okay, I can here on the slideshow. So here it says that recovery rebate credit, I highlighted here. So that one is the one that's a form like line number, this one to 10 as on the form 1040. If they have not paid, it's a line number 30, recovery rebate credit. So they can use that, and then if they have not received it, they claim that line number, whatever the amount they are eligible for. So that's a specific, if they are like married filing jointly, so married filing with the 2 kids, and the first time they did not receive it, then the 1200, if they have the valid social security and will valid for work, 1200 for the couple, 2400, and then 600 for the kids. Sorry, 500 for the kids for the first time, which will be if they have 2 kids, 1000 plus 24, 3400. And the second time they did not receive it, and that each one they are eligible for 600. Family of 4 with all 4 social securities eligible, and the qualified children, that too, and the qualified children has to be age 13 or below, 16 or below, and then that's with the valid social security, and they have to be here more than 12 months in the US. In order to like more than 6 months to be a qualified children in the US. That's 600 for the second stimulus payment, and then family 600. That's another 2,400. 2,400 the first time, 3,400. With a family of 4, most of them they got 3,400 and 2,400. Yeah, 600. So which will be almost 5,800, stimulus payments for the family of 4 already received. They can claim the recovery rebate credit.
Okay. So I think we covered all the questions, unless anybody has any questions. Sunil Garu, do you see any more questions anywhere?
No, and we conversation. So I think we are good.
All right, okay then. So thank you so much, Chandrasekhar Garu.
Sure.
And I'll invite Mr. Ravinder Kamtam Garu to convey the vote of thanks. Ravinder Garu.
Yeah. Hello. Can you hear me?
Yes, Ravinder Garu, yes.
It was really very wonderful session, sir, Shekhar Garu.
Thank you.
I want to start by thanking first our generous donors for both TATA and NYTTA. And I take this opportunity to by appealing to the donors to keep continuing blessing both organizations. And I also extend my thanks to the volunteers who involved in executing this program, starting from concept to completion, especially Malik Garu, Pavan Garu, Sahodar Garu, Usha Garu, Vani Garu, Sunil Garu, and Rama Garu, our NYTTA president. And thanks to all the participants and all the and our community members who joined this session. And also I thank the advisory council, BOD team, and EC of TATA, advisory council, BOD team, and EC of NYTTA. And finally, this is a tax season, and CPS were really very busy, and especially today is a weekend and Saturday. And despite of that, I really thanks from bottom of our heart, Chandrasekhar Garu, for your time, not just for this session. This session might lasted for like 2 hours, but you might have invested a lot of your time and resources in preparing for this session. So it was very exhaustive and informative session. And we really thanks. We thank all the team from both TATA and NYTTA for all the efforts in executing this program successfully. And thank you again, guys. Chandrasekhar, one more again, thanks one more time. And all the community, we have the contact number of Chandrasekhar. And going forward, any questions on for a personal level or for businesses or anything related to taxing, investment, whatever it is, Chandrasekhar Garu is always reachable, and we have his information. And with this, I conclude this session. Thank you, Ignore.
Thank you, everyone. Thank you, Ravinder.
Thank you all. It was fun.